So let's dig into the construction of these ETFs, starting with FIRS. This is your Wealth Builder ETF. So how is this ETF specifically constructed to help its investors build wealth over a long period of time?
In the journey to financial independence and financial freedom, there's really two phases, right? You have an accumulation phase. That accumulation phase is where you're saving as much as you can and you're investing it into things that are going to grow during that time period, right? Then you have a distribution phase. That's I've achieved financial independence and I need to take some of my income off of that or my principal and live off of it. So the FIRE savings or wealth builder is an alternative to the traditional method. Most of the FIRE folks buy VTI or VU or the Schwab dividend portfolio, and they buy it and hold it forever. And there's absolutely nothing wrong with that, except if you're 2 or 3 years from retirement and the market completely collapses. Guess what? Now you're 3 to 6 years from retirement. If you've got a 20-year time horizon, you don't really have to worry about investing in the S&P. If you've got a 5-year time horizon, you should worry. So the FIRE savings portfolio is constructed to be diversified by having exposure to the S&P 500 through various different ETFs that are on the title trust. So we have a Gotham fund in there. We have one of Tom Lee's fund, the Granny Shots. We have SoFi's version of the S&P 500, or the large cap 500, they call it. Then we also have exposure to commodities. So we have exposure to gold, to Bitcoin, to oil, to real estate, to things that tend to do well in inflationary environments is once again a hot button term. And then we have an exposure to bonds, both long-term and short-term. And the thesis is when you have all those things together, you should be able to weather pretty much any environment. So we've had years where the S&P or the US equity markets are down 50, 60%. Those are the years where this portfolio should not be down anywhere near that a fraction. Because when equities collapse like that, gold tends to do well, bonds tend to do well. And that's the idea.